Have you ever wondered why so many different finance professionals give you different advice? There is actually a correct option, but we're also human. During this episode, we're going to look at what the professors say, what the academic community says about finances, and compare what financial gurus say, what professors say, and then what I tell people to do. So, hello and welcome to the Plain English Finance Podcast, a podcast dedicated to helping you make smart financial decisions. I'm your host, Trey Bino, certified financial planner and chartered investment manager, financial planner TC Wealth Management and Aviso Wealth. Okay, this one is a cool one. So, there is a professor that I followed for quite a while now. As you know, a lot of my learning has been done through studies and stuff like that.
Mm-hmm.
Anyway, I thought there was a really cool paper that he did. Really cool paper.
When you started, this is a good episode. This is going to be fun. I was trying not to smile.
Yeah. Anyway, there is a paper that he did comparing. It's called Popular Personal Financial Advice versus the Professors.
Oh, okay.
Right, that's pretty cool. And he goes through, basically compares a bunch of financial gurus and their books and stuff like that, and what they recommend and what their advice is versus what the academic community says. And here is something to know about personal finance. That many people will say there's not a right and wrong way to do it. There is. It's just that people want to tell themselves because it makes people feel better.
Okay.
It's like if you want to go and learn how to be an astronaut, there is a right and the wrong path. If you there's some leeway there, but
like nuances.
There's some small nuances, but not on the scale that people believe there is.
Yeah.
And it's very true with personal finance. Okay. So there is a few different categories here that he goes through. So yeah, we'll go through. I'll read out what the consensus for the popular advice is. Like he looked at the books and stuff like that.
Mm-hmm.
We'll look at.
Are you gonna source the books? Are you gonna throw shade on the?
No. I would say so. It was like Dave Ramsey's book.
Good old Dave. He's been featured in our podcast many times.
Yeah. So it was. He lists them all if you want to go check it out. But it's 50 of the most popular personal finance books.
Okay.
So it takes
like Rich Dad, Poor Dad.
Yeah, all of them. He's got a list, whole huge list of them.
Okay.
Path to Wealth, 4 Pillars of Investing, Automatic Millionaires, tons. There's literally.
Oh wow.
These are.
So he read all of these books, is what he's saying?
That's a really good question.
Maybe that's not exactly what he's saying. Maybe he's just pulling things from the sources.
Yeah. There'd be a lot of books to.
Yeah, that list looked a little like.
But they're saying that
outrageous.
you're a professor, so you don't do it. You just get your underlings to do it.
Or you're a professor. Do they just read a lot?
Maybe.
An obscene amount.
Yeah,
I don't know.
But anyway, so this is by James Chow. He's he's the professor of finance at the Yale School of Management. Okay, so he's a bigwig in this world.
Yeah.
Okay, first one is talking about saving.
Yeah.
So the popular advice is save 10 to 15% of income, regardless of age and circumstances during working life.
Right.
Okay.
I feel like I've heard that on different YouTube.
Yeah.
Like Dave Ramsey or something.
It's a pretty common.
Yeah. Save 10%. Save 10%. Yeah.
By the way, we're both very sick.
We are deathly ill right now.
Okay,
Deathly. We're doing this for you. Just kidding. The listeners. Just kidding. No, we're pretty sick though, to be fair. It's been, and we've been sick for a long time. Not a super long time. I'm giving too much information, but basically we were like, oh, we'll do a podcast today. Oh, we're both feeling sick. Let's do it tomorrow. And it's just been pushed on and on and on. And somehow we're worse. So now we're just doing it probably at the peak of our illness. So sorry about the voices. My throat is so sore.
Yeah, sorry, what I was saying. Okay, so save 10 to 15%. Don't annuitize. So basically use an annuity to offset the risk. So give it to somebody else, like an insurance company.
It says don't do that.
Yeah, don't do that. It's consensus popular advice.
Sorry, when you are referencing, this is the section of the gurus, like books.
Popular advice.
Okay, popular advice. Okay.
Yeah, regarding saving.
Okay.
Spend to keep real level of wealth roughly consistent in retirement. So don't draw down too much. Basically, you're spending what your portfolio is making, not really more than that.
Okay.
Okay. Divide savings into mental accounts devoted to different goals. So saving for my yacht.
Into mental things? Okay.
Yeah, like mental accounts. Like this money is here for this. This money is there for that. You know?
Yeah.
Okay. So that's the consensus popular advice. And then the academic advice. So smooth consumption over time. So basically you want to focus on your consumption and you want to keep it steady. And give me that look. We'll get to what I recommend.
No, I'm waiting to hear you say. So in other words, don't die. Sorry.
Okay, low or negative savings rate when you're young. High savings rate in midlife.
Okay, say that again.
Savings rate in midlife.
What?
So low or negative savings rates when you're young.
Low or negative savings rates when you're young. Okay.
Yeah, so save less when you're young.
Yeah.
High savings rate in midlife.
Okay. Well, yeah, because you don't have any money when you're young anyway. What can you save?
Yeah. Fully annuitize wealth in retirement. So basically get rid of the risk.
Yeah.
It's like,
give it to somebody else.
Give it to somebody else, right? And it's a different type of risk. But if not annuitized, negative savings rate in retirement.
Okay.
Which makes sense. All wealth is funded. So basically, look at it as the bigger picture. Don't put it into these small mental accounts that this money's for that and this money's for this. Think of it as an overall thing.
Like this is a large sum of money, and this
across all my accounts, everything's in one pot. Retirement savings aren't specifically for retirement or
it's just savings
specifically for this money. It's just assets. Now I just choose how to access those assets based on stuff.
Quick question for a sidebar. Do you think it's just because humans, do you think this is all tied to people being afraid to like run out of money? So they're like mentally trying to track like, okay, I need this much for retirement. I'm just trying to think of it from that point of view. Does that make sense? Where it's like they need to have like things separated.
Like the mental accounts you're talking about?
Yes, the mental like savings accounts that they need to have things.
Do it all the time. You do it. You did do it.
I'm like people. Who are these people?
So you tell me why you would do it.
That's why I'm trying to give the perspective.
Yeah,
I think people like to.
People like
these
people.
Who are these people?
Yeah, I think maybe.
It's like you want to know. I am going to talk about it from my point of view, I guess. You want to know how much you need for certain things. Like if I have a savings goal, okay, I want to save this amount for this vacation. To me, in my mind, it's easier if I have a separate thing where I can see it like moving towards that goal.
Yeah, because it gives you probably little dopamine hits. It allows you to stay motivated. I think there's lots of reasons that people.
And then you know when you've reached that goal versus like if it's in a big like universe of money and it's growing, yes, and stuff like that's true, but it might be harder to be like to keep track of what your goals are. I'm guessing that's why the popular advice is that, I guess, for that point.
Yeah, I think you'll find, which is a theme when you look through this, is that the popular advice is easier. It's a lot easier to just implement for somebody with very little financial literacy.
Right.
So like save 10 to 15% of your income. It's really easy to in fact, I'm getting ahead of myself. Okay.
Sorry.
Those are two things.
I am already ready to jump down that rabbit hole too. So
now mine. So what I recommend.
Okay.
So first off, the 10 to 15% is like, so I'm definitely more on the smooth consumption over time. Set expenses. You knew I was going to do that.
Separate your income from
your
your
expenses. Absolutely. The single most powerful thing that somebody can do to change their financial life trajectory, their financial life is single. No, it is, because if you do this, you'll probably want to learn the other stuff.
Yep.
Is to do that. Is to separate your income from your expenses. Is do not have your income dictate your consumption. And once you do that, life is so different, because you will build extra money that you can use for other things. And when it talks about low or negative savings rate when you're young and high savings rate in midlife, guess where that comes from? It comes from you choosing what your consumption level is. So as your income grows, you automatically will save more, right? It is a fundamental approach to money management that I get that it is harder. And this is what irks me a little bit about my industry, is just because it's harder doesn't mean that you should water it down.
So it's like the hard truth is you got to be responsible for your financial literacy, and you need to kind of not follow
build
these
the self-discipline, build the systems in order to better separate your income from your expenses.
It's like, because you're changing your behavior. And again, I think we've talked about this in previous episodes where humans love the black and white rules. So if someone is like, as a rule, save 10%, humans are like, ding, ding, ding.
Yeah, love that.
I love that, because I don't have to think anymore about it. So I know we've talked about that before. I kind of forget where I was going with that. That's the end of my point, I guess.
but you're right. I think that it's just because it's easier.
Yes. Oh, so on the other hand, the argument that I'm thinking of this, just because something is easier doesn't mean it's right. But are these gurus and I hate that word, by the way. I hate saying it. I hate hearing it. Anyway, it's just so stupid. Sorry. Anyway, these authors of these books, are they saying it because it's also realistic? So if they know people, again, it's easy to say you're choosing the easy route, but humans love the easy route. So maybe they're saying this is the popular advice because at least you're doing the minimum, right? Instead of nothing, you're doing, you're starting somewhere. Sorry.
And see,
devil's advocate over
no,
here.
you're absolutely right. My issue is that they don't specify that, right? So they're not saying, hey, you should run and exercise every day, but if you're not going to do that, make sure you get 10,000 steps or whatever it is, right? They're not saying that, but in other things they do say that. You know that the right thing for you to do is to eat healthy and do all these things. But if you're not going to do that, here are some good alternatives. That's not how it's portrayed. It's portrayed as, no, the right thing for you to be doing is to be saving 10 to 15% of your income. It's like, no, that isn't the right thing. The right thing for you to do is to control your consumption and save everything else.
Yeah.
Right? But
people don't
if you're
want
not
to
going
hear
to do
that,
that, then do this. So I'd much rather that be the approach of, this is the right thing to do. We know this is the right thing to do. If you're not going to do that, here's plan B.
Do you find that's because that's actually building financial literacy? Similarly to the health example, if a doctor is saying, you know what, as long as you stand for a few minutes in between sitting all day, you should be fine. And you're like, that's good advice, doc. I'm going to take that. And now I'm a healthy individual, not understanding the standard, actually, the right thing to be doing for a healthy life is to be doing these things. The doctor isn't being responsible and telling you the actual information and then letting you choose what to do because it's your life and your health and blah, blah, blah. Is it similar where an author saying, this is the right thing to do, but that's a lie? It's not building their financial literacy and understanding what is actually going to benefit them and then allowing them to make that choice. Am I actually capable of making the hard behavioral changes and implementing my consumption rate and all those things?
Viewing it differently, right? Because the next part is, so the, all wealth is fungible part, right? All wealth, think of it as one thing.
What was that word?
Fungible.
Interesting.
Yeah. Only a professor would use that.
Yeah, I'm like, that's a new one.
And so thinking of everything as one big thing.
Yeah.
by committing to smoothing your consumption over time, you have to understand your whole life and how it plays into, like it's like you're setting a framework for your whole life. And that's very different than just saying, okay, well, right now, today, I have X amount of dollars hit my bank account, so I'm going to save 15% of it or 10% of it. I think that's a much harder for a lot of people to do, is to think to themselves, okay, I'm not, I want to be a pilot. I know that in piloting, I'm going to make roughly this much of my income. I know that it's going to take me 6 years to get there, though. Okay, well, for these 6 years, I'm not going to be able to save as much. I want to live at this lifestyle. But that means that when I'm making $150,000 a year, $200,000 a year, it means during those years, I'm going to have to maintain this same lifestyle until I've caught up. That is a much bigger thing to commit to get your mind over, that will allow you to spend more now when you're younger, that a lot of people just aren't willing to do and commit to, right?
I was going to say, as soon as you started though, okay, I want to be a pilot. A lot of people don't even have that. Do you know what I mean? Like, people go to school and they're, what do you want to do? I'm just taking business. Like, I'm sorry, I'm not trying to offend. Maybe that was a little offensive. Nothing wrong with taking business.
The best school for business is go out and do business.
Well, but do you know what I mean? Like, a lot of people don't have their whole lives planned out. And I think they get overwhelmed with, you can plan, but things are also changing. So you do need to be flexible in some regard. And I think that could be a very overwhelming thing to ask a 20-something-year-old. Think about your career. What do you want to do? Make sure you're doing all these. Do you have your financial literacy in order? Do you have the, because in your midlife, that's, I would guess, 30s, 40s for finances kind of thing. So you're asking a 20-something-year-old to be leveling. I'm trying to think of it from all the facets.
And that's why they might just say,
just save the 10% you're
right. It's just, again, I wish, because it almost, let's say the common knowledge was that that's what you should do. It means that people won't go through their 20s and say, oh, well, everybody does that, so it's fine, everybody blows their 20s, like everybody. It's like, no, the common knowledge is now that your 20s matter a lot. So you need to be making a plan for them as well. I think it puts the onus back on the individual, and there are people out there that do want to have big goals and dreams and stuff with their finances, that it would, instead of them having to sort through all the crap to find out what they should be doing, I think it would help those individuals. But okay, anyway, we're gonna get way too the second part.
Oh, sorry.
Yeah,
shake it off
here. Okay, portfolio equity share. So, popular advice: hold money that might be spent in short term entirely in cash. Money that won't be spent in the short term may be invested in equities. Equity shares should be hump shaped with respect to age. So as you are younger, you'd hold more. As you get older, you would hold less.
Taper off. Yeah. Makes sense.
This is going to be a lot more complicated. Is there
you were trying
academic advice?
You were trying to find a better word. No, it's just complicated. Good.
Okay, so invest money that will fund near-term consumption more conservatively than money that will fund consumption far into the future. Okay,
sorry.
So it is not entirely in cash. It is the fact that it should be held in things like fixed income.
Okay.
More conservative type investments. Bonds, yeah, it's fixed income, yeah.
Okay. Okay. Stocks and bonds.
Yeah. Okay. Equity share should be hump shaped with respect to age. As a caveat. Equity share should depend on how quickly marginal utility diminishes and how much stock returns will be impacted with marginal utility. So basically, as you lose the ability, you yourself are an asset. So as your asset diminishes, then you would reduce the amount of equity that you would hold. Because if you think of you as a fixed income, you need to replace your fixed income-ness. Does that make sense?
So
if you
like your
think of a
health
portfolio, let's say a portfolio is $1 million.
Yeah.
And of that portfolio, $300,000 of it is my value.
So your income of whatever.
My future earnings, that's what I'm assigning my personal value.
Yeah.
Right. So we're saying but we're including in this portfolio my personal value. If I'm fixed income. So if I am early on, everything else that I have needs to be in equity because I want my portfolio to be long term, to grow and things like that. But as my value, let's say from that $1 million, as my value goes to $200,000, that $100,000 difference should now be in fixed income.
I see.
Because it needs to replace my
value.
Yeah. So it's a really important point here that it's not necessarily about age. It's something completely outside of age. It is about the utility, which is why things like trusts and like long-term money and things like that, when the money is not going to be used in your lifetime, it's about when that money is going to be used, not when it's going to be passed on to the next generation. It's about when you're going to take that money or somebody's going to take that money and exchange it for something else. And that's a really important thing to think about, especially when you're investing with much older ones that have more than enough money that they would ever need. You are trying to minimize different types of risk. So, therefore, the time horizon is extended well beyond the age of these type of people.
Right.
Okay.
But again, how would you know? I guess that you would put it in a trust and be like, whenever the next generation needs it.
No, it wouldn't necessarily go in a trust. I'm just saying that's why. So let's say I am 95 years old and I have $1 million and I spend $10,000 a year. Okay, that means that realistically, if I live to 110 years old, it's 150 grand, right? There's another millions of dollars left.
Yeah.
How do I invest that money? Just because I'm old doesn't mean that I have to put all that into a GIC or in cash or something like that.
Right. I see.
Because that money is not going to be spent.
The
time frame for that money is
unknown right now.
Yeah,
it's so far away that you should always be putting it in equity, but
so it should
per se.
Yeah.
Okay, that makes more sense because people are tying it so much to individual use and retirement, I think.
Yeah, they do.
Individual use, retirement.
Wealth.
Wealth is
right, and that's what people
tricky.
Miss. That's what people miss is that it's not about same way when you pass it, and it's on that principle is also very important when you're passing wealth onto the next generation. It's often something that is that you have a responsibility to the wealth to manage the wealth properly.
That's so funny,
right? And because people view it so individual, and that's why money that is passed down the generations, I think it was by the second generation, most of that money is gone. Right? It's because there's that value there that people don't pass down properly. A lot of what you spend your time doing with very wealthy families is working on the next generation.
Crazy.
For that very reason, because it's more money than they're going to spend, and they won't know what to do with it, and you need them to have the same values and stuff like that. Yeah.
That's a very interesting, I don't know why I've never thought about that a little bit more. You're responsible to the wealth. That was such a funny saying.
It's like a job.
Yeah, it's like a little
the job.
child. You know what it actually makes me think of? Like a board of directors.
Yeah, absolutely. That's exactly. I think people would be better with money if everybody at some point was responsible for managing money that wasn't for them. Exactly like
you liked that point. That made me feel good that you were so happy about it.
Okay. Dividends.
Yeah.
Consensus. Oh, shiver there. Okay. So the popular advice, high dividends are attractive. This is for dividend investing. There is a huge following for dividend investing.
Mm-hmm.
What do you think the academic advice is?
Stop caring so much about
High
dividend
dividends
investing.
are unattractive.
Wow.
And
Polar
people,
opposite.
complete opposite. How about you've put the right back down? What was I saying? Oh, I was saying about the dividends. So the dividend, the dividend strategy of buying companies that have a historic pattern of raising dividends, so that even when they drop, they'll be paying dividends, and you can use that to buy the stock. It's a really powerful reasoning because it makes sense. It makes a ton of sense. When you actually look into the numbers, though, the dividend itself is a terrible measure of the outperformance of a stock or not. There are other things that are absolutely to do with profitability, to do with the size of the company. There are things that there is the research done. There is proof that these things can better predict how a company is going to perform.
Right.
Dividends are not one of them. So in a world where there is no taxation and no costs or anything like that, it is neutral. Heavy dividend portfolio versus a non-dividend portfolio. In a world where we have taxation, the dial swings, and the dial swings hard.
Okay.
It is significantly better that a company buys its own stock back in the market and increases the value of my stock so that when I sell it, it is a capital gain,
right,
than to pay out dividends to me.
Yeah.
So
So you're saying they should take the money and invest in the business so that it's more valuable for the shareholders?
They don't even have to do that. They could just buy back it's called a stock buyback. I'm not going to go into that, but they can just, instead of giving it to shareholders, they can just buy shares. So they can just buy shares from the open market. Naturally will increase the value of the shares that are left over.
Right.
So it's by the same amount. Like it is very obvious on paper which one is better. This is editing Trey here. If you're struggling to understand this concept, think of a capital gain strip. So this is a transaction that the government has been attacking lately, trying to stop corporation owners from being able to do. And the essence of this transaction is it turns dividends into capital gains. And that is in essence what a stock buyback does, is it takes dividends, money that would be taxable in that year, and converts it into a capital gain that can be taxable at whatever point in the future. So that is similar. The only reason that type of transaction was very attractive is because capital gains in the current Canadian tax system are superior to almost any other type of income. It's the best tax treatment. So when you're picking between a dividend or a capital gain, under the current tax code, the right decision is a capital gain.
Okay. Yeah.
For some reason, though,
people want the dividend.
We are obsessed with dividends. We're obsessed with this idea that companies are paying out dividends, forcing us to pay taxes when we don't want to right now, is the right approach. And yeah, so hence we're in an environment where I think the last time I checked, I saw numbers somewhere, it was about 50% of companies choose buybacks now versus dividends. So it's definitely increased dramatically. It used to be way, way, way smaller. Because I think as investors are getting smarter and more educated, they are like, if it doesn't matter to me which one you pick,
why not pick the right one?
Why not pick the one that's going to put more money in my pocket?
Yeah. But is it, again, because a dividend is like an instant gratification thing for.
Yeah, it's like a feel good, right? It's
Yeah.
stocks are down, but it's still paying me 5-6% in dividends. Yeah, I'm just buying more shares with it and everything. And yeah, if you actually really think about it, I don't have to pay tax on that and all this stuff. But at least it's hitting my account. I feel good about it.
Yeah, it's a human thing again.
Very much so. And the reason I was saying that was it, and I'm saying it is this way of thinking permeates all levels of income or levels of like smartness, I guess is the right way
Yeah,
to say it.
because it's
Whereas,
not about knowledge, or well, it is partly, but again, it's our human instinct.
yeah, and it's a great story that I was gonna say that there's a potential client I'm working with right now, and I did some brief numbers. When this family retires, if I had what they have and invested it the way that I would invest my money, be worth about 35 to $50 million by the time he retires. This family,
Oh my.
okay, and when I say like they have been sold this dividend investing approach, but their income is so high that it is brutal. Like they are throwing away thousands and thousands and tens of thousands of dollars to taxes
Ugh.
for no reason because they've been sold this heavy dividend approach. And it's like, it's one thing to do it when you're in a low tax bracket.
Yeah.
It's quite another to be doing it in a much, much higher tax bracket. It's just constant this
That's tough. That's a
yeah,
tough one.
it
I
is.
hope they're not listening right now. I'm sad.
Okay, next one is equity style. So
Yeah.
popular advice: value stocks and small stocks are attractive. Academic advice: value stocks and small stocks may or may not be attractive.
Yeah.
Kinda,
It depends.
it depends the approach.
Yeah.
Not gonna say much of that. The data shows that if executed well, it's attractive. Small stocks are inherently a lot riskier.
Yeah,
than
for sure. This is the
larger
same
stocks,
thing about
right? So
isn't there, we're invested in a portfolio of like smaller businesses,
but it
right?
is tilted towards smaller value. So that speaks to the dividend side, is that the companies that tend to pay higher sustainable dividends tend to be smaller because they need to attract. Sorry, tend to be smaller because they have to attract investment. Tend to be value because they are they have a sustained cash flow.
Oh.
What just happened?
So, the camera disconnected.
Okay, so yeah, so okay, value stocks. Move on. International diversification. So hold international stocks, but far less than in proportion to their global market cap weight. So how big the company is you own the company by, if it makes up 5% of the total stock market, you own 5% of the stock.
Okay, yeah.
Okay, is
Easy.
what market cap weight means.
Okay.
And then the academic approach is hold international stocks in proportion to their global market cap weight. So that is the like the consensus popular advice is not in proportion to the global weight. The academic advice
Is.
is
Yeah.
in accordance to their global weight.
Yep.
Okay, active versus passive mutual fund management. The popular advice, what do you think it is?
I would feel like these guys, they would agree on this one, hopefully.
Yeah.
Ah.
So invest only in index funds, passive index funds.
Yeah.
Academic advice: invest in passive index funds. It doesn't. When you look at the data, I'm having this conversation with another potential client, where it's a case of the returns are what the returns are, and when you look at the data, yes, some active managers outperform the index.
Yeah.
It is a bet you expect to lose.
Yeah.
And the cost of picking one of those ones that significantly underperforms the index is too much.
Yeah.
It is, and because you don't expect to win the fight, and the consequences of losing the fight can be pretty bad, it isn't worth it to pick that fight.
Yeah. Don't enter the fight.
You don't enter the fight.
Yeah.
And that's what it is. Ultimately, it comes down to when you're looking at active versus passive management.
Right.
Not to say that there will be 20% of the people or so will beat the index. The issue is that you could be part of that 20% that beat the index, or you could be part of the 20% of people that underperform the index by 60%.
Yeah.
Not worth it to even flip that coin when they're the two options.
Yeah.
Right? So,
too much of a gamble.
Way too much of a gamble. Okay. Non-mortgage debt. So the traditional advice, either prioritize paying highest interest debt or low balance debt. So snowball or
Avalanche
method.
Yep.
Co-holding low interest assets and high interest debt may be a good idea.
That's the popular advice or academic?
Popular advice.
Interesting.
Which is a weird one. I don't know why. Anyway, benchmark advice, like academic advice, prioritize paying high interest debt.
Yeah.
Do not co-hold low interest assets and high interest debt. I would be interested to
understand that one more.
I'm sure that he like breaks it down further in the. It was a while ago I read this, but I might have to. I wonder why that would ever be a good idea.
Yeah, I'm like, even for
holding low interest assets and high interest debt.
They're like just for fun, just for funsies. You know, and they want the payday loan with their yacht.
Yeah. I don't know. Okay, mortgage choices. Choose a fixed rate mortgage.
Choose a fixed rate mortgage. Okay.
Choose an adjustable, so variable mortgage.
Oh, this is so the popular advice is fixed.
Yeah.
You should
pick a variable rate mortgage unless interest rates are really low. So
right.
When interest rates are really low, then it's like, okay, it's, you could go fixed, but for the majority of the time, you'd be better off having an adjustable rate or variable mortgage. And this speaks to Canadian mortgages as well. Like,
yeah,
you are better off in general to go with the variable, even through that.
For ours. Oh man.
Yeah, it jumped significantly.
Yeah.
But when I did the numbers and looked at the math, we were still ahead because we'd been paying off a low interest rate mortgage, a lower interest rate mortgage than what the fixed 5-year was for the preceding 7 years or whatever. So
yeah.
And
it just people again when you're in it.
And this is where looking at the whole picture,
yeah,
when I talk about for a lot of people, it's so difficult because in order to make good financial decisions, you do have to be able to look at the whole picture and to understand that a decision that you make isn't
because of today and how I feel right now, and because the numbers are high at the moment, and
you're trying to guess what's going to happen in the world, and like it's just like
predicting. And
I don't do that. That's not how I make decisions or teach people to make decisions.
Yeah,
it's based on what is the right thing to do here.
Yeah,
this is what the data says. Okay, now let's work backwards. Why shouldn't I do this? If people made these type of decisions like that, you'd become more comfortable,
right,
with them. But that's it. They're the areas that he does break it down further.
Good paper to look at. I mean, maybe other people wouldn't read the whole thing, but it was pretty interesting. I will say, I was into it.
Oh, cool.
Yeah. It was a good episode. It was a cool paper. You were right.
Heck yeah.
And I'm not a nerd. Just kidding. I am. Oh, sorry. I thought, is this not focused? Or am I just...
Who knows at this point?
This has been a rough one. Physically, technically, mentally. Just kidding.
Okay. Anyway, that's it. So thanks for listening, and we'll see you in the next episode.
Bye.
Bye.
Thanks for listening to this episode of the Plain English Finance Podcast.
Thanks for listening to this episode of the Plain English Finance Podcast. Trey Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities are offered through Aviso Wealth, a division of Aviso Financial Inc.